again, it's Paul Spence with the Collat Tutor Lab. Today we're going to discuss Chapter 6, which is on internal control systems, petty cash, and bank reconciliations. At least the parts of it that we'll be covering are. First and foremost, internal controls. Very important. An internal control system basically has four purposes: protect assets, ensure reliable accounting, promote efficient operations, and urge compliance and adherence to policies and procedures. It's kind of funny, this last one, because policies and procedures is considered a form of control in itself. So there are actually layers of internal controls. They build upon themselves. Essentially, an internal control system is a checks and balance system a company comes up with to ensure that their assets are protected, that people aren't sending in fake invoices for stuff they never did, that employees aren't stealing things they're not supposed to take. It's a way to protect their assets that way. And by doing that, they ensure reliable accounting. They make sure that when you get that balance sheet or that income statement, what you see is accurate. It's not wrong because there's stuff missing they didn't know about, or things were taken, or the numbers were changed also. And then to promote efficient operations. Believe it or not, it's also to make things run better. It's not just an extra step you have to take, but it's also a way to improve the efficiency by making sure the information is accurate and there's a quality system there. You don't have to worry about constantly double checking yourself. A big part of internal controls, SOX, Sarbanes-Oxley Act. We spoke about this briefly in Chapter 1. I kind of gave you a rough shot definition of what it was. And so here's a more accurate definition. It's a requirement of managers and auditors of publicly traded companies, will be specific. It's only for publicly traded companies, to document and certify their system of internal controls. So they basically have to write that we created a system of internal controls, we tested that system, we've made sure it's worked, we've made sure that there's no gaps in it or anything, to the best of our ability, and this is us signing off and saying we approve of them. And by doing so, they're saying because we have this system of internal controls, our accounting is accurate. The numbers are correct. There's not any faulty numbers, no fraud, nothing that's missing that we didn't notice, that kind of stuff. All right. Their requirements of SOX are that auditors must evaluate the internal controls and issue an internal control report, which is included in the annual statements of the publicly traded company. Auditors of a client are restricted in which services they can provide to the client. Essentially, an auditor can't create an internal control and then turn around and audit that control to make sure that it's working. I mean, it's considered a conflict of interest. You can't be certain that they're actually testing it and being authentic if they're the ones who made it and now they're checking to make sure they made it right. It's an issue, so you can't do that. The person leading the audit can only serve 7 years without a 2-year break. That's actually, I got a little caveat to that. That's what your book says. There's actually an additional thing they added afterwards. Some cases, they can only serve 5 years, and then they have to rotate out and let someone else come in. So keep that in mind, 7 years or 5 years. It could be either one. And then auditors' work is overseen by the Public Company Accounting Oversight Board. This one is a big one. This was created by this bill. It is an actual group, as a lot of people like to call them, peekaboo, because that's what they do. They come in and they make sure that the auditors are doing their job. And they're the ones that enforce all the other rules and regulations that were created by SOX. It's a big group right here. And then harsh penalties exist for violating SOX. And by harsh penalties, we're talking 25 years in prison or millions of dollars in fines. So it is a very big deal and important that you understand it and make sure you follow it. Principles of internal controls. First, establish responsibilities. Obviously, you want to make sure that when you create a control, or when you're thinking of creating a control, you set somebody to be in charge of it, someone who's going to be responsible for developing it, someone responsible for enforcing it, those kind of things. Then maintaining adequate records. Obviously, you got to have adequate records to be able to keep track of whether you're doing what you're supposed to, having proper metrics and all that. Issue key assets and bond key employees, or excuse me, insure. It's hard to read from up here. So in insuring key assets and bonding key employees, that's a very specific principle. Obviously, if you have a very large building or land or property or something like that, very costly, very expensive, you want to make sure you insure it so that if anything does happen to it, you're not out a huge loss. And then bonding key employees is very important. It's basically an insurance policy for that employee. So say you have an employee who has access to the company's bank accounts, like the Apple employee that can sign checks for Apple. Well, Apple's bank account has billions of dollars in it. What's this, what if this employee starts just writing checks to whoever? If the employee's bonded, then the company's not on the hook for those checks. And they can be reimbursed, and that bonding company, whoever bonded that employee, is going to go after that employee and get the money from them. It's having someone step in and say, we believe this person's reliable and you can trust them. Separate record keeping for custody of assets. All right, this is also segregation of duties is what it's referred to. Basically, if somebody's recording that this was done, you don't want them also having access to it. So you buy a piece of equipment and you have somebody bring the equipment in and install it and run it and management, or you buy merchandise you want to sell and someone brings it in, puts it in the warehouse and watches it in the warehouse. You don't want that person to also be filling out the books and saying this is how much we have, because what's to stop them from saying, well, we got a shipment of 10 of this item, when in reality they got a shipment of 15, and they just take those 5 and take them off. You'll never know what happened to them. There's no step there. So by separating those two things, separating those duties, segregating them, you prevent that. One person watches it, the other person records what came in, and you can keep that there. Another segregation of duty is responsibilities for related transactions. Again, transactions that are related to different things, you want to have different people working different sides of it. You don't want the same person doing both sides of the transaction there. Another thing with the recording and custody of assets, there's a third one that's not listed here that's also just as important, and that's the authority, especially when you're dealing with, like I said, with the Apple, the guy who can write the checks. If he's got the authority to write the check, you don't want him having, the ability to actually go in and cash a check. So he doesn't have custody of the assets, and you don't want him recording it in the books. This check was written out to this guy. So you want to have that authority to cover things separate from the custody of it and the record keeping. It's a third step there. Applied technological controls. This is also known as IT controls for record keeping. Obviously, everything's moved from paper to technology. Like myself, I'm sure most of y'all grew up with computers, or at least have been exposed to them for a very long time now. Phones and smartwatches, we're getting there. You want to be able to control those things and make sure that people can't access your IT systems and do things with the information on them that they're not supposed to, change records or have access to records they're not supposed to. So that's become a really big one that a lot of people have really gotten into. It's a huge growth area. And then finally, perform regular and independent reviews, and that's going to be your audit. That's people coming in and saying, we're going to check your internal controls, make sure that they're functioning properly. If they need to be improved, tell you how to improve them. If you need to add some, tell you where you need to add them, or tell you need to add them, however that works out. So that's the final step in these principles of internal controls. Right? But that's internal controls in a nutshell, real short and simple. Now we're going to move on to a problem for a petty cash system. All right, and we're going to show you how to work petty cash. All right, so this is going to be problem 6-3A on page 292 in your book if you want to move to it so you can follow along in the book and work the problem with this. We've got most of the basic information is there. Dennis, the one who's working the screen for me, is going to kind of keep me up with what the actual problem says so I can walk you through what the steps are. So it appears this first step, we established a petty cash account. So we took $300 from cash, we credited cash, and debited a separate asset account known as petty cash. All right, now, petty cash is for small expenses that happen so regularly or so irregularly that they're hard to follow, or you don't want to just have to keep making a transaction for them. So you just run them through petty cash, keep the receipt, make a little mark, and then at the end of whatever period you choose, you decide, thank you, you decide, to close it out, double check it, and then you make all your transactions there. Just kind of make things a little more efficient. All right, so we established a petty cash account, $300. All right, and that was on May 1st for a Kiona company. All right. It says that on May 15th, we prepared a company check to replenish the fund for the following expenditures made since May 1st. All right, so the first expenditure was we paid $88 for janitorial services. All right, so we got a debit to janitorial services, which would have been an expense for $88. Next was 5368 for miscellaneous expenses. That could have been anything, again, why you have a petty cash account. Postage expenses, 5350, and then advertising expenses, 4715. So these were all of our expenses. All right, well, if you see over here, it says we had cash on hand of $62.15. That's what was remaining in the account. Okay. And our expenses, if totaled up, equaled $242.33. That gave us $304.48. So if we were to write a check for the amount we paid and put it back in there, we'd have $4.48 more than what we started with. We'd have an overage. That means that someone accounted for this incorrectly somewhere. It happens. You know, like I said, these are small things, quick, dirty, keeping track of them. And so we're going to have these overages. Either someone missed a receipt or they put too much money back in change. And the way we report that is we'll credit an overage shortage account, cash over or short, for the $4.48 that we were over. We'll subtract that over here from what our expenses were to find out what our replenish amount is. And we'll take from cash $237.85, which will go back into petty cash. Yeah, even though it's debited from the cash account, it just goes right back to the petty cash account. That's where you'd write the check to. All right, it says on May 16th, they decided to raise the amount of the petty cash account to $500. That looks just like when you opened it. Real quick, just $200 debit to petty cash, $200 credit to cash. Then on the 31st, they had some more expenses. Postage expense, $147.36. Business mileage, $23.50. Merchandise inventory. Now this one is the interesting one. What y'all actually see is it says that we had $34.75 of delivery of merchandise to a customer terms FOB destination. So just in case y'all haven't covered that yet, the FOB destination means that it was freight on board, we shipped it. Destination means that the person shipping it is paying the shipping expense. If it's FOB shipping point, it means the person receiving it is paying the shipping expense. Very confusing because it flip-flops. It's hard to track. A way I try to remember it is for the benefit of shipping point. And that means they get the benefit of not paying it, so the destination is paying it. So if y'all want to remember it that way, you can, or any other way you want to remember it. But it was FOB destination, so we're paying the shipping costs. When we pay shipping costs, it's not expensed. It's actually put into an asset account called merchandise inventory. We capitalize it into the inventory, and then it's expensed later on when we sell the inventory. So that's why that goes into merchandise inventory, if y'all were wondering for that. Again, we add up our expenses, compare it to the cash on hand. This time we have a shortage. If we were to put it in there, we'd be short the $500 that's supposed to be in there. So in this case, what we're going to do is credit or debit the cash over a short account for the shortage. We would take the expense, add the shortage, and get the amount that we need to debit from cash or credit from cash, which would be the $211.80. And that'll get us back to the $500 we're supposed to be at. And then finally, they decided that $500 was too much in petty cash. A $400 limit should have been what it was. And so we'll just do a reversing, debit cash 100, credit petty cash 100, and switch it back out. So very quick, very simple. Like I said, the biggest thing to remember is when it comes time to check it, add up your expenses, compare it to cash on hand, and see what that equals out to. If you have an overage, then you're going to do a credit to over and short. And if you have a shortage, you're going to do a debit to over and short. That's all you need to know for that. So moving on from that, we're going to move into bank reconciliations. This will be a little easier for y'all, or for me at least. This is going to be QS 6-6 on page 288. So if you want to flip to that real quick, you can catch up with this. I have most of the information up here already just so I can follow it a little easier. So it says that on June 30th of 2000 and whatever year, we had a book balance in the cash account of $22,352, and a bank statement said we had a balance in our checking account of $21,332. So obviously these don't match up. So we're going to do a reconciliation to try and match them up. And that means comparing things out. So what do we know? The first thing we know is we have outstanding checks. in the amount of $3,713. We've written some checks and mailed them out. And so they're on our books. We've said, okay, we wrote this check, put it on our books, and mail it. But they haven't been cashed yet. So, excuse me, the bank doesn't know about it, so they're not on the bank statement. So what do? Nothing. There's no journal entry for this. It's already on our books, so we don't have to make any changes here. Instead, down in this lower part, you're going to go to your bank statement, start with the starting balance, and you can either add or subtract, whichever one you want to do first. It usually does add, but you just make a little mark. Outstanding checks need to be subtracted, and you'll put that right there. On the second thing, we have the debit memorandum. This is basically the bank saying there was a service fee. You know, banks charge fees. This is letting you know the fee was charged. We've taken it out of your account. So we need to put that on our books now. It's on the statement. It's not on the books. So we're going to debit bank service or service fee or whatever it would be for the $41 and credit the cash account for the $41 to take it out. And that puts it on our books. And again, down here, so you can compare these afterwards, you're going to make a little note. Here's what our beginning balance is. We're going to need to subtract out the $41 from it. Next is a recording error that is marked. We mailed a check for $90, but recorded it in our books as $99. So on our books, it's a $99 withdrawal. On the bank statement, it's a $90 withdrawal. We need to match that up. What we need to correct is our books. So we're going to go back to our books and say we really have $9 more in here than we did, so we're going to debit cash for $9. And then for the credit, it's going to depend on how much information you have. If you know what that check was written for and which expense account it needs to come back out of, you know, if it was to make a payables payment or pay for janitorial expenses, then you're going to credit that account directly. If you don't have that information, then it kind of depends. But you'll usually try and figure out what it was for and make that correction directly to that account. Next, cash receipts. So we went in and dropped off a cash deposit after hours on June 30th. So obviously, on our books, it says we've deposited this into cash, but the bank hasn't put it on our statement yet. So we'll need to go and do nothing to our books. Right? It's already on our books. It's not on the statement. So we'll need to go to the statement and add that. So that's what this is here. Added the cash receipts, subtracted the outstanding checks, and we got a balance of $22,343. Right? Last thing up here, interest earned. The bank let us know that, hey, the money you had in savings or checking earned some interest. Here's what your interest was. Well, we didn't know that until we got the statement, so it's not on our books. So we need to add it to the books. Debit to cash, credit to interest revenue. We're going to recognize that as interest revenue. So $23 debit, $23 credit. And again over here, we got our recording error, $9, interest revenue, $23. Add that in. Subtract out the debit memorandum of $41, and we get $22,343. Now these numbers match. So that's how you're going to do this. You know, like I said, the most important thing to remember when doing this is, where does it need to go? Okay, was it on our books? Okay, is it on the statement? If it's on the statement but not on our books, we'll need to add it to our books. If it's on the books but not on the statement, we don't have to do anything to our books. There's no journal entries, but we are going to want to make notes of it both times so we can compare at the end and make sure that we've matched everything up and it does equal out. And that's bank reconciliations. All right, well, that's that for Chapter 6. If you have any questions, again, Collat Tutor Lab at uab.edu or Collat Tutor Lab through Skype. We'll be happy to help, and thank you and have a good day.